So, start. Good morning, everyone. Welcome to our Insight series on the tax reform in Nigeria. My name is Chijoke Owebute, and I'm the Tax and Regulatory Services Leader for PwC Nigeria. And for us, it's really important that we have these kind of sessions because these are the sessions that will help us to kind of engage with, people to kind of, talk about the impact of the tax bills. And we know that with the reform environment we have in Nigeria now, there's a lot of uncertainty. People are not quite clear as to what the direction this is going. And what we're looking to do over the next 1 hour is to give you our perspectives. The focus will be on individuals, startups, and from the feedback we've gotten from our sessions so far, it's really been interactive, and people have been able to also kind of create opportunities to actually engage with us further. And I really encourage everyone to just, relax, engage with the presenters, ask the questions you need to ask, and please feel free to communicate and contact us after this. There will be opportunities for you to do that as well. I will hand over to my one of my colleagues, Oluwatoyin David, who is Director in People and Organization Business Unit, to kind of take us forward. So over to you, Toyin.
Thank you so much, Chijoke. Good morning, everyone. Nice to have you here with us today. Like Chijoke said, my name is Oluwatoyin David. As a director, I work as part of the People and Organization team here at PwC. And this morning, we'll be looking at the tax reforms as it affects us as individuals. I'm sure everyone is interested in knowing what the implication might be for them. We would also be looking at how it affects startups and family businesses. So it's really going to be an insightful session, I must say, and we would all have opportunities to ask those burning questions that we have in mind. So to take us through this session is Esiri Agbeyi. Esiri is a partner here at PwC. She's also the Africa Family Business Leader. So, I mean, for you to see that, that's really the best person to take us through the session this morning. Esiri has a background in microbiology, and I'm sure we're all wondering, microbiology and accounting, what's the correlation? She's a well-rounded professional. She has, she's a fellow member of the Association of Certified Chartered Accountants, ACCA. She's also a member of the Institute of Chartered Accountants of Nigeria. She's a tax professional as well. And then she has gained some professional education from London Business School and the New York University. So Esiri, over to you.
Thank you very much, Toyi. Okay. Thank you very much, Toyi. Very happy to be here with everyone. And this is the best part of the series, just so everyone knows, because we've had previous ones, but this is as it touches your own individual pockets, family businesses, but also startups as well, is what we'll be focusing on. As we all know, the reform is huge. I must say that. So this 1 hour session would not cover every single thing. I hear there's an echo. All right, so I'm just going to go on with the presentations. All right, so what we'll be taking today, we would be looking at the overview of the tax reforms, including the rationale for it, We would look at key changes for individual startups and family businesses, and then just get through some general guidance and insights. If anyone hasn't heard just now or heard in the past few weeks what has happened, this page is for you. So the president has signed the 4 bills into law on the 26th of June. We expect that they will become effective from 1st January 2026, as the signed versions are not yet publicly available or have not been gazetted as is expected. So some of the things we would be discussing here are largely coming from the versions currently in circulation. There might be changes, which is the caveat here before we go into details. Now, the key objectives for the reforms were really around consolidating all of the laws, tax laws as we knew them under the existing tax system. If you're a business practitioner, you'd find that every single time when you wanted to consult on what the tax implication of a transaction or a business change was, there's so many laws that you have to basically consult. So basically what has happened now is consolidating everything into one omnibus act. One omnibus, big, beautiful act. The other thing is harmonizing tax administrations across the different tiers of government. Under the Constitution, the federal, the state, and local governments all have separate powers to administer taxes. And what this is looking to do is reduce those separate functions or collaborate them in a manner that allows for efficient revenue collection for the country, but also reduces the cost of collecting those taxes for the country's benefit as well. And by so doing, improve the ease of doing business. Lastly, it's really looking at enhancing equity. So a lot of coverage for vulnerables, the vulnerable population, and a lot more emphasis on the high net worth individuals, paying their fair share of taxes. There is also a move to digitize the tax processes, and in so doing, also cater to the advancement of the digital economy with certain incentives that have been included in the Act. So let's go into details. What does the Act cover? What do these Acts cover? We would look at it in 4 buckets. One is the type of taxes that are covered under the Nigeria Tax Act. So that is one primary act that covers all of the taxes that you will have to deal with, whether at the individual level, at the corporate level, as a startup, or even a group of companies as well. All the taxes you need to know are enshrined in the Nigeria Tax Act. The party who would be responsible for administering those acts or parties are enshrined in something we call the Nigeria Revenue Service Establishment Act, that basically renames FIRS as the Nigeria Revenue Service and also allows for easy collaboration with state tax authorities and in some cases the local government authorities as well. In terms of how the taxes would be collected, the Nigeria Tax Administration Act covers all administrative provisions, including the penalties, how we would pay those taxes, what kind of identification number do we need to have to remit those taxes, is covered under the Nigeria Tax Administration Act. And lastly, which is a very useful introduction in the tax regime, is basically spelling out the taxpayer rights, allowing for protection mechanisms, but also the dispute resolution around disputes that will emanate between the taxing authorities and the taxpayers. And under this act as well, we have the creation of something we call the tax ombuds, which would be an independent arbiter between the authorities and taxpayers in resolving issues. Now, when we go into the key changes, we've kind of identified or selected some key points that we thought we should discuss here. The hope is that you'll get at least significant messages coming through from here. And in a later session, when we're able to dissect this in a longer duration, we would look at specifics in each of these areas and more. So we will cover residency and the employment income because we know these are where key changes are coming from. We'll look at the available income tax reliefs. We'll also look at the exemption thresholds. They are higher, and to the point about equity, but also protecting the vulnerable. This is one of the big changes that have come through. New taxes and rates as well, we will cover. We'll also cover the minimum effective tax rate, which is also advancing towards equity as well, and ensuring that big players pay at least a minimum type of tax. We will talk about taxation of digital assets, especially for our tech creatives or digital nomads that may be on the call. We would look at the direct disposal of shares, which is a new introduction. We'll look at VAT changes and surcharges as well. Look at startups and the EDTI framework. The EDTI is basically the Economic Development Tax Incentive that has replaced something we used to know as the pioneer status. And the pioneer status basically gave you some holiday which exempts you from taxes, income taxes. And we'll look at the changes in that framework. Then we'll look at the Joint Tax Administration and the tax ombuds as well. To start off, one of the big changes we're seeing for individuals will be the way they would be taxed. How do you identify who's taxable in Nigeria on a worldwide income basis? And who is taxable in Nigeria on only income that has been sourced? There's a concept we call residency, which some of us will be familiar with. In the existing acts, we never really had that term defined. We only had it defined for the purpose of identifying the states that will collect the taxes from you. So you would hear things like, I'm resident in Lagos, I'm resident in Ogun State. Sometimes Lagos and Ogun is fighting because someone is on the border. Those were what we had enshrined in the act. But when you looked at the larger context, you didn't have that context defined in the sense of if a foreigner came in here, or even if a Nigerian had jackpot or left, would they still be considered tax residents for a period of time? When we look at countries like the US, residence is based on citizenship. So wherever you are in the world, you pay taxes on your worldwide income. With Nigeria, even if you moved to another jurisdiction, from the day you moved, you probably aren't taxed anymore in Nigeria, but that's going to change now. So we have 5 key things that are going to drive the definition of who's resident and who's not resident. One is where you're domiciled. 2, where you have a permanent or domestic place of use. So somewhere that is permanent for you, you would easily visit there, change, sleep, eat your food. If you have 2 wives, which one is the primary place, depending on your wife's, the law for your wife. Those are the kind of discussions that will come up there. The other 3rd point is around your immediate family ties, substantive, immediate family ties. And those will look into things like whether you have businesses that keep you connected to Nigeria. It could also consider things like existing bank accounts that still make you tied to the country from an economic standpoint, and other definitions that may tend to be subjective, but really would be at the tax authority's discretion, and also the taxpayers would be their owners to kind of explore that and determine their residency as well. The 4th point is around whether you exceed 183 days within a 12-month period in the country. So we generally know this to be the 183 days rule, and it's something that's resident in most of the treaties that we have signed with other countries. If you stay beyond 183 days in Nigeria, you will be tax resident. It's also possible to be tax resident in other jurisdictions outside of Nigeria, even if you had stayed less than 183 days here or stayed more than 183 days here. And so there's a possibility of paying taxes in 2 jurisdictions, one at a time. The way this is solved is through tiebreakers, and those are things that will be covered under the treaties, or you'd have to determine independently. But then we'll look at also the relief that's available if you got to the crossroads and there was no way out of that double tax. The reverse is the case. If you don't meet any of these, then you are non-resident and you are taxed only on your Nigerian sourced income. There are additional exceptions in the Act, which we haven't put all here. But one of the key things to take away from here is, as a non-resident, you would be taxed on Nigeria's sourced income if you also have not paid taxes in another jurisdiction. So we have to also test that you have paid taxes in other jurisdictions. There is an additional point around startups and creative arts, but also technology-driven services. If you're non-residents of this type of organizations, you're exempt from taxes in Nigeria, but subject to having paid taxes in another jurisdiction. Treaty exemptions may exist to mitigate the double taxation. One other point we see here which has changed is as it relates to the employment income. Remember that as a Nigerian resident, you would have to pay taxes on all sorts of income. Your employment income, your side hustle, your business income from other jurisdictions. You travel to the US, you're selling hair. That income is also taxable. You have interest income coming from your fixed securities. That is taxable. You have rental income because you have houses in the UK, in the US, in the UAE. You're a Nigerian resident, that income is also taxable. So you would bring all of those income streams together and calculate your taxes on them. On employment income specifically, there are additional conditions that are set there for Nigerians. If you're a Nigerian who is working abroad and your income is exempt in that foreign country, so say you work with a regional FDI, a FDB, or IFC, you work in a foreign country, your income is not taxed in that foreign country because there is an agreement with Nigeria that exempts that tax. You would be required to file taxes here in Nigeria and pay taxes in Nigeria now, simply because you're a Nigerian. And the same applies with international organizations. Yeah. So let's look at a quick example, and this is also coming from what we have spoken of previously. Tunde is a Nigerian citizen, performs all of his employment duties in Ghana, and assuming Ghana exempts his remuneration from tax due to an agreement with Nigeria, Nigeria will tax Tunde's salary. The income would otherwise go untaxed if Nigeria didn't tax it, and what this law is looking to do is plug those kind of loopholes. Let's look at also something around the relief. Remember, I said there is a possibility that individuals might now be subject to double taxation. If there is a treaty with Nigeria in the past and currently, you can get a credit that you would use to reduce the taxes that you'd pay in Nigeria. If there was no treaty, however, you probably don't get a full credit. You get a deduction of that tax in Nigeria. And the difference then would be you don't get the full amount dollar for dollar or naira for naira as a deduction to offset. So you kind of lose in that sense. But now there is a clear credit relief that's available even where there is no treaty. So it increases the bandwidth for how much you can deduct as credits. So if we had a scenario where this individual, for instance, let's call him Musa for sake of argument, had houses in Mauritius, and he had a house in United Kingdom that he was renting out and generated 300,000 from rent, generated 150,000 from rent in the United Kingdom. In Mauritius, he had paid 30,000 in taxes, and in the United Kingdom, 15,000 in taxes. These are not the real tax rates in these jurisdictions. They are only used as examples. Previously, your credit would be available at a minimum of 15,000 from the UK because we have a treaty with the United Kingdom. We don't have a treaty with Mauritius, however, so the credit available is probably the tax amount applied on that 30K, so really lower. But now you get all of those taxes as a credit to reduce the amount that you might pay in Nigeria. So as an example, if we take the total 450K and apply 20% on that, assuming that to be the Nigerian tax rate, you'd have to pay $90,000 as taxes. Because you have credits in the form of the taxes you paid in Mauritius and United Kingdom in the form of 45K, it reduces how much cash you then have to pay to the taxing authorities. Reliefs, that's also another important one. And this has changed as well. The big change here is around the consolidated relief allowance. So we used to have something we call the consolidated relief allowance that basically gave you at least 20% of the taxable income as a relief. And what that did was it substantially reduced how much you paid in form of taxes. If you were in the top bracket, say, the top bracket we used to have was around 20%, 24%. If you took that relief off, you ended up at about 18% in form of taxes. Now that relief has been replaced. So it's lower, and it's the lower of 500,000 or 20% of the annual rent that you pay, with some conditions. You do have to disclose the landlord that you are paying the rent to. The previous release, as you know them, continue to exist. This is the one that you see on the right side of the screen. Your contributions to NHF, contributions to the National Health Insurance Scheme, your life assurance premium, your pension reform contributions, and the interest on loans for developing an owner-occupied residential house will still be available to deduct. There are higher exemption thresholds. This one is great news. For small businesses who have turnover of 100 million naira and below, and they also have fixed assets of 250 million naira and below, you would be totally exempt from taxes. No income tax, no withholding tax, no development levy. The exception is professional services. So you provide accounting services, legal firms, real estate surveyors. You're excluded from this. So you're not a small business for the purpose of this act, and you would still have to pay your taxes. Individuals also have a higher exemption bracket on your individual income. If you earn 800,000 naira per annum and below, you're exempt from taxes. Also, we found that the first tax bracket has increased from 7% to now 15%. The top rate has moved from 20% to 20% to now 24%. In terms of redundancies, we also have that if you were given a compensation because you lost your employment as a result of a redundancy, there was a big change, you know, in the organization that required that a big division needed to be skived out. Then whatever compensation you get for the loss of your employment has been increased now from tax exemption from 10 million to now 50 million naira. So if you were paid 100 million naira as a ballpark sum, 50 million of that will be exempt, and then the extra above that will be taxed, which is your 50 million. Capital gains, good news is that now losses are deductible, and I think we'll start to appreciate more why this is important, more for the digital assets, because now there is a clear taxation rule around digital assets like your cryptocurrencies, those bitcoins that we have, non-fungible tokens, those will all fall in that category. So if you sold any of those and there was a capital loss, make sure you keep a record of those losses, because you can take a deduction for them when there is a gain in the future. There are new taxes and rates that we all should be aware of. Development levy is a new term. It's a new term. 4% of your assessable profits is now referred to as the development levy, and really consolidates. Again, remember the objective for this reform is about consolidating. We don't want too many taxes that we have to always remember. We've kind of, you know, merged that into one single levy. So it's replacing your education tax, the IT levy, the NASENI, amongst others. And if you add all of it, actually, it comes up to about 4%. Small businesses and non-resident companies do not have to pay this levy. These are the PIT rates, all the way from your 0% to 25%. And then you can see the different brackets there. Your first 2.2 million is now at 15, 9 million at 18, and all that. In terms of capital gain tax, a big change here is that now you don't have different rates. So before now, we used to have a capital gains tax rate, or currently we have a capital gains tax rate at 10%. At the end of this year, 10% will cease to exist anymore. From 1st January 2026, when this law is expected to take effect, you will now start to tax your capital gains at either the 25% top rate for individuals or the 30% rate for corporates. Yeah, so no more 10%. So it blocks that arbitrage that we used to have, where it's possible for an individual to say, oh, this is not a gain. Maybe I disposed of shares. You say it's not trading income, it's actually a capital gain. And I tax the disposal of those shares at 10% as opposed to the income tax rate. Now, it doesn't even matter that you make that distinction because all of them will be taxed at the same rate. But it's still important to have those distinctions because remember that you'll have different types of losses that you will need to offset against each of those gains. You can't take a capital loss and offset it against a trading loss. So you'd have to keep mapping those so that you have segmented returns that you'd be filing. A new introduction is the presumptive tax. If a person's income cannot be ascertained, they will be taxed under a presumptive regime, and this will be based on rules to be set by the minister with input from the Joint Revenue Board. There is a minimum tax for Nigerian companies, and we had a session on non-residents earlier. You can also find that recording where we have dealt with this in detail, but I thought to bring this up here as well because Nigerian companies have been redefined. So a Nigerian company is not simply on the surface of it, a company that has been incorporated with the CAC. It's also a company that's effectively managed out of Nigeria. And quite a number of family businesses tend to have this type of structures where you might have a buying company or a procurement company in the UAE or BVI or Cayman Islands that's helping to buy products that you import into Nigeria for sale or you use them for producing your goods. If you are the only person that's substantively managing that entity outside, that BVI entity or the Cayman entity could effectively become a Nigerian company. And so you'd have to consider whether they should be also paying that minimum tax, because whether we like it or not, in some of those jurisdictions where these entities have been set up, they actually are low tax jurisdictions. And so by definition, they would come within this bracket and there will be a 15% minimum tax that's payable, no longer 0%. And this really calls for revisiting some of our existing structures and seeing whether or not there are substantive activities going on in those areas that could basically rename those companies as Nigerian or foreign. And also determine whether this minimum tax applies to you. The minimum tax is calculated as a percentage of something we call the net profit before tax, as reported in your audited financial statements. The version that we have, and some other versions as well, so it's different, but it talks about reducing that further by 5% of depreciation and personnel costs for that year. So it kind of increases the profit and reduces the profits on which the minimum tax would apply. But this again is subject to the final version. The rate applies to who? Companies that are part of M&E groups, companies that have aggregate turnover of 20 billion naira and above. Again, this version shows 20 billion. The final version may be 50 billion. So we need to be on the lookout for that. Taxation of digital assets is a clear provision that's now introduced in the Income Tax Act. When cryptocurrencies became a thing, you recall that there was quite a lot of grays around whether or not they should be taxed at capital gains. Why were they considered as being taxed at capital gains? Because in some sense, they were considered as being currencies. But then we had restrictions from the authorities like the CBN that didn't recognize those as well. So it left a gap. Should it be income, trading income that we tax as well? What the law has done now is to put it within the scope of chargeable income. It has expanded it by including digital assets such as cryptocurrencies. And what this means also for us is it raises a lot of questions. It raises questions around how will it be valued? Under the Act, the valuation of those currencies are subject to the approval by the relevant taxing authorities. Number two is the fact that under the law, you pay your taxes in the transaction currency. So the transaction currency in this case is your crypto, but then you have to convert it to something else for the purpose of paying the taxes. So would it be dollars? Would it be naira? Those are questions that are valid, and those need to be looked into as well. Of course, losses can be relieved, and we spoke about that earlier. But if we look at this example, assuming an individual called Alice buys 0.05 Bitcoins for, say, 500,000 Naira. At the time she wants to buy a laptop, the Bitcoin is worth 700,000 Naira. One can easily look at this and say there is a gain, right, of 200,000 that we will tax at what rate? 25% or 30%, depending on if she's doing it through a corporate vehicle. Now, if we look at what's going on in other jurisdictions, some jurisdictions do not regard this as a transaction for capital gain. They look at it as just an exchange using a currency that we recognize. And so we have just bought an asset. There shouldn't be a gain. But then there are some other jurisdictions that consider it a capital gain and tax it. So these are the kind of rules that we think will emanate following this act to give guidance on the implementation challenges that we see here, ranging from the volatilities that one will experience, how the taxing authorities will have access to the valuation of those if they don't have access to those crypto exchange platforms, how it will be treated from a cross-border perspective. So you're, say, a Nigerian sitting out in the UAE, you bought the Bitcoin, would I still have to pay taxes to Nigeria or not? How the losses will be recognized, and just generally the administrative burden given the regularity or frequency of transactions that happen in this space. So a lot, but this is the starting point, I dare say, and a lot of engagement I think will be required to fine-tune the rules. Indirect disposal of shares, now taxable in Nigeria. And I'll give a quick example, also try and reach out to our slides that we did or the recording on the non-residents where we've dealt with this in detail. If you look at this example, say XYZ Nigeria, ABC Mauritius had 100% shares in XYZ Nigeria, and then you had some 3 individuals who are residents in the UK that owned shares completely in ABC Mauritius. And that at the top, it might also be a private equity firm, it might be a venture capital firm. Before now, or currently, disposal of shares at the level of XYZ Nigeria, so I disposed of shares in XYZ Nigeria, is the only thing that I would have subjected to tax. Now, if I decided to dispose of the shares in ABC Mauritius, because the value underneath ABC Mauritius is sitting in Nigeria, there would be a Nigerian CGT that applies at that level. So this is what we mean by tax applying on the indirect disposal of shares. There are exemptions if the disposal proceeds are less than 150 million and the chargeable gain does not exceed 10 million Naira in any 12 consecutive months, then it's exempt. If it's reinvested in the same or another Nigerian company, that exemption still remains. We had it in the previous act, but the first bullet point is new. Of course, questions arise around who has the responsibility to account for the CGT, especially seeing that these are non-residents disposing of the shares. In some jurisdictions like Tanzania or even Ghana, sometimes what tends to happen is that gain is considered realized at the local level, with the local entity being required to account for the taxes. So they don't have to bother that the non-resident has done it. They just look through the ownership and they see that there's a change in the ownership structure, and it is deemed on that day that certain assets and liabilities have crystallized, and so there's a gain computed on that basis, which the local entity would pay. But of course, we should expect that there will be rules around this as well. What about closed Nigerian companies? What do we mean by closed Nigerian companies? You have a company, you set up 5 shareholders or less, you're a closed company. You can also be a closed Nigerian company if you're a foreign company, but then the shareholders in that foreign company are domiciled in Nigeria, stay in Nigeria, effectively manage that foreign company from Nigeria, you will fall into these brackets. Now, if you choose not to distribute dividends to these shareholders for any reason, The tax authorities have the powers to deem the distribution has happened and tax those distributions. How can the tax authorities determine or prove that you should have distributed these dividends without detriment to the company's business is a big question, because this is the basis on which they can assess that tax anyway. And so we think that a lot of care needs to be looked at, and this is where documentation is important, including the governance structure within the companies. What kind of dividend policy do you have? Do you have a dividend policy that means that we must reinvest our profits and we don't have to distribute those profits? Has that been documented? The last time we did our family business survey, I think it was 2 years now, and even the one for last year, less than 30% of family businesses have a dividend policy. So structure, this is demanding now for a lot more structure, a lot more governance, a lot more processes around your risk and compliance to ensure that you're audit ready, when these questions are being asked. You need to watch out for loans to shareholders. Could those be interpreted as, oh, I've given a loan to a shareholder and that's why I'm not distributing dividends? And a lot of Nigerian companies will be affected here. Excessive profits and cash without reinvestment plans as well is also something to watch out for. If you consistently have record year of no or low tax liabilities, also something to watch out for when this clause can be triggered. Let's quickly move on to the VAT changes. We've probably all been hearing about e-invoicing, VAT fiscalization. If you've traveled out the country for any time, you'd find that sometimes when you're buying some of these products, I'm not going to mention the products here, but some of us ladies know them. They'll say, oh, do you want to pay by cash or do you want to pay using our machine? It's cheaper if you pay by cash. Now, there's something called fiscalization that means that when you pay on those machines, real time, the authorities have access to what you have paid and also the VAT that's due on those charges. And that's why it's more expensive in some of those jurisdictions, because of the VAT that you then have to pay. So Nigeria is getting or aligning itself with international best practice and coming up with VAT fiscalization. It's mandatory for businesses, of course, subject to the registration cap. And I think that's about 50 million naira now. Again, subject to the final version. So you don't have to register for VAT, and therefore you may not need those fiscalization machines when they are launched. But the revenue does have, or the taxing authorities have come up with a pilot program that will bring in large businesses with 5 billion naira turnover and above to start with this VAT fiscalization. Non-compliance is expensive. It attracts 200,000 naira as a penalty, but 100% the tax due, and interest of 2% above your CBN MPR. So please, this is not a joke. For a lot of businesses that have gone past the SME bracket, this is something that you would need to pay attention to. And it raises a lot of questions around, one, what products are exempt? What products are zero rated? How do I classify them? So imagine a store where I'm selling essentials that are zero rated. And by zero rated, it gives you the opportunity, it's quite different from being exempt. It gives you the opportunity to recover the VAT you suffered on the purchases, which is different from exempt, where you can't recover the input VAT. So you must classify the products that you're selling, one from the other, and be able to then use your e-invoicing appropriately where the VAT is required to be charged. It means by inference as well, you must maintain accurate and real-time records. Some of these would need to be digitized. So accounting, EPR upgrades, probably necessary as you start to transit into the new system. Staff will need to be trained and upskilled. You may need to digitize your invoicing and receipts and test and integrate with FRS. That should be NRS systems. They're no longer called FRS. Prepare for real-time reporting and audits as well. Other changes that we're seeing, and I'm just going to run through this quickly, bearing in mind that we have time constraints. Input VAT deduction, I've mentioned that during the course of this, but guess what, guys? If you're a service company, before now, you couldn't recover your input VAT, so you provided accounting services, professional services, the real estate company. Sometimes you couldn't recover your VAT, but now you can. So you can recover it, and it's been expanded to even fixed assets and services. You need to now understand how the apportioning will be done. So upskilling is required as well to upgrade in that sense. There is a time frame within which you can recover it, 5-year limit, and sometimes it may be impractical to deduct if your output VAT has been deducted at source. There is a refund mechanism that's been introduced in the law with a time frame of within 30 days, but it remains to be seen how effective the cash refunds will work. And we're hoping for the best. Zero rated goods as well, we now have those. So like I said, some of these essentials were exempt before. So with them being zero rated, you can recover the VAT. And what this means, it's huge, because prior to now, all of the goods that we buy in Nigeria and the services we buy have an element of repeated VAT. So all of the services that they have used to provide that service to you, they couldn't recover that VAT. So there was a hidden VAT cost in those pricing. Hopefully, with the fact that you can recover this VAT now, the prices of the goods might drop or maybe stabilize, because whatever has gone up doesn't really come down sometimes with the pricing of goods and services. So we'll see how that goes. But there's a long list, and we've just put some of those items here. There's a surcharge that the Act has also introduced called a fossil tax at 5% on fossil fuel products. And this is really moving us to that green era where we need to start reducing our carbon footprint. It does not take effect immediately, and the effective date will be announced by the Minister of Finance. There are certain products that have been excluded from the fossil tax, renewable energy products, household kerosene, cooking gas, CNG, but definitely diesel will attract a tax like this if it is ever imposed. Startups, I quickly run through this. If you're a startup, you have turnover of 100 million or less, you have fixed assets not exceeding 250 million, zero tax rate. You're also exempt from the development levy. Your R&D activities are deductible to encourage innovation. Gains from investments in startups. So you're a venture capitalist, a private equity firm, you have an interest in a startup. If you dispose of those shares, they are exempt, but you must have held those shares for at least 24 months before you enjoy those exemptions. The employment income of the non-resident employees that work with startups are also exempt from taxes. And I think we mentioned that before. So you're a non-resident that works with a startup or a creative arts arrangement, so movies, all of this theater production, you bring in foreigners to work here, musicians, and the catalog of people that follow them, maybe they are bouncers, they are non-residents, they are potentially exempt from tax in Nigeria if they have paid taxes, and the same applies to startups as well. The business expense deductibility rule has now been restricted to whole and exclusive and reasonable tests and the necessary tests removed, so it increases the ability to deduct. There are tax incentives as well for certain sectors, and we've mentioned some of these here. If you see your sector, shout for joy. It replaces the pioneer status as we knew it, that used to give a tax holiday of at least 5 years at the maximum. Instead of you just getting an exemption from income tax, this will give you a pool of credit. So 5% of your qualifying capital expenditure that you can use to offset different tax types for at least 5 years. If you reinvest the profits for another reinvest 100% of the profits you made in those 5 years in the business, you get another 5 years extension. So you can get it for as long as 10 years. And applicants must meet minimum specific investment thresholds ranging from 250 million naira, which I think applies to sportswear manufacturing, to about 200 billion naira, which I think applies to the gas supply space. So updates around the Joint Revenue Board, the fact that the taxing authorities can delegate their function to audit to other tax authorities means that we might see a lot of collaboration on audits and taxpayer data sharing. There's a possibility of a single harmonized tax identification number, because now, instead of having the gaps we used to have between taxing authorities, where one tax authority in Lagos State or FCT is dealing with an individual, but doesn't know that there's a company that's registered with the FRS or not registered with the FRS that's not paying taxes, they will now speak to each other. So it reduces the inefficiencies in tax collection. The tax ombudsman will be the independent arbiter for issues related to disputes or protecting the taxpayer rights. If you don't have the money to employ consultants, you can go to the tax ombudsman and they would help defend your case as well. There's stricter enforcement, and we should pay attention to this. If you can take a picture of this, take a picture. See higher rates, administrative penalties as high as 40%, for VAT fiscalization as high as 200,000 naira if you don't plug into the VAT fiscalization machines or download the software, depending on how those would work, plus 100% of the tax due and interest at a rate of 2%. If you award a contract to an unregistered person, administrative penalty 5 million naira. So again, it's encouraging us to formalize the informal sector and have a lot more informal participants become companies. Reporting changes also exist, with quarterly returns due by banks, tax planning arrangements to be disclosed, and also simplified annual returns. So there's a lot coming from here. I've lost my breath just speaking through, and there's going to be a lot that we need to unpack. But there's a lot of actions that's required from us, including sensitizing yourself and management team, assessing or doing your whole holistic assessment, impact assessment on how this applies to you, probably articulating your tax strategy properly, properly documenting the governance, including whether you need a risk register or not, and then articulating your communication strategy and change management as well going forward. This is a big change for the tax community and also for businesses. And hopefully you got one or two things from here, but I'll kind of stop here and bring on board Toyi. I've eaten into our time so that she can speak very quickly.
Okay, thank you so much, Esiri, for that insightful session. And it's actually interesting to see that our participants are already thinking restructuring. So there is a question here. For SMEs, are there provisions to take care of SMEs owned by the same persons? What prevents someone from establishing different SMEs and keeping them all under 100 million naira?
Okay, great question. Yeah. So there's joint administration now. So let's hope that you'll be able to hide under the cover, but I doubt it. But there really will be a sharing of information across board, and the tax authorities have ample powers to identify where there's tax avoidance and basically raise an assessment. So it will be in your best interest to do that only where it is commercially reasonable to do so. Yeah.
Okay, thank you, Esiri. Another question. Will the 15% minimum effective tax rate be applicable to companies that have net loss before tax?
So if you have a loss, yes, you would have, because remember that one of the trigger points would also be your turnover. So you'd have to look at the turnover. But then the question will be, if you have a net profit before tax or a net loss before tax, it's possibly unlikely that there will be any taxes. And if we then have to reduce depreciation and take out the personal expenses, there might not be taxes. But I'd like to say that you should wait for the final version as well before going and leaping for joy, because there are actually additional caps that may be introduced there. Yeah.
Okay. On the exemption from withholding tax deduction for exempt businesses, if a client were to insist on deducting withholding tax, what proof can the business provide to show that it is exempted?
Yeah, so I think that this is something that we're still grappling with now, because some businesses actually just take the conservative approach to deduct from everyone and insist that you go and deal with the tax authorities by getting a refund. Hopefully refunds will be done faster now. But It's possible also that with the help of JTB and the tax ombuds, there might be a simplified requirement or reporting that one can do as an SME that advances your cost for being labeled as one and shouldn't be exposed to the withholding tax. But these are things that we think will come out in regulations proceeding. Yeah.
Okay, thank you, Esiri. Another one, the Naseni levy currently applies to the profit before tax of commercial companies with a turnover of 100 million and above, particularly in sectors like banking, telecoms, ICT, aviation, maritime, and oil and gas. Will the newly introduced development levy extend to companies that are not currently subject to the Naseni levy?
Sorry. Well, sorry, Toyin, could you take that again? I think I lost you for a bit.
Okay, that's fine. Can you hear me now?
Yeah.
The Naseni levy currently applies to the profit before tax of commercial companies with a turnover of 100 million and above, particularly in sectors like banking, telecoms, ICT, aviation, maritime, and oil and gas. Will the newly introduced development levy extend to companies that are not currently subject to Naseni levy?
Yes, so there's no exception. There is no exception to the development levy, so it will apply to all companies apart from SMEs.
Okay. For multinational enterprise groups that include tax-exempt entities, how are they expected to comply with the 15% minimum effective tax rate requirement under the new rules?
Is that for multinational?
Yes, for MNEs.
Okay, so MNEs who find that they are tax residents or they have established an SCP, a significant economic presence, or have a permanent establishment in Nigeria would have to register for taxes. They have a minimum tax of at least 4% of their tax that they have to pay here. Nigerian headquartered companies also have a minimum tax they would pay. But then if their foreign subsidiaries do not add up to that 15% tax, it's not the foreign subsidiary that pays, it's the Nigerian headquartered company that pays the top-up tax. So in different scenarios, you would have different payers depending on what they are registered for.
Okay, so someone would like a bit more clarification around how to recover input VAT where there is no output.
Yes, so I think on that particular point, it's something that already we have in some industries like the oil and gas industry where they could still recover some of the input VAT, but unfortunately output VAT had been deducted at source. You'd recall that in the past couple of years, the telecoms industry was also added where certain companies were identified as agents to deduct the output VAT at source. So it remains a problem because then if the output VAT has been deducted, you're trapped with input VAT and you can only recover that by applying for a refund. So there are two possible ways. One is getting a refund directly from the government, a cash refund, or that refund being admissible as a credit to offset other taxes. But then it would require that you interact with the taxing authorities, they approve it, and hopefully they can do that within a 30-day timeline so that you can utilize it.
Okay. What about the minimum tax for companies that have no taxable profit? Is the loss carried forward still indefinitely?
Oh, yes. So tax losses can be carried indefinitely.
Okay. So there's a question around employee reliefs. For an employee who has not provided a record of annual rent paid, will the 500,000 rent relief be granted automatically when determining the taxable profit?
Yes, so there's a 500,000 or a percentage of the annual rent that you pay. Obviously, they will need evidence of the annual rent paid for you to be able to get that. Otherwise, you get the 500,000. Remember, it's the lower of the amount. So in any case, 500,000 is almost a given.
Does a filling station have to file and pay VAT also?
Yes.
Okay, right on the mark of 11 a.m. I think we can wrap it up here. If you have any more questions or would need clarification around any area that we spoke about today, feel free to reach out to any of our team. I think there's okay, so I'll pass the mic back to Esiri to just talk us through some of the future events that we have, which we think, you can learn a thing or two from. Esiri, over to you.
All right. So we have the Insight series that we're going to be launching very soon. We already have the top 20 changes, which we have shared previously, but you can find out also on our web sites. There are upcoming trainings. Remember, upskilling is important in this thing. Even us, we're still reading and reading those laws. They're over 200 pages, so there's a lot to learn and unpack. So we have 2 sets of training. One that's running from July to August, which is a hybrid one, and so also physical. If you want to see my face, Oluwatoyin's face, come and meet us there. Scan the barcode and be part of those sessions. You see, we have general sessions and also deep dive sessions. So you can get more details when you go on that site. Then we also have another one that's happening in Kenya. Kenya happens to be one of the countries where e-invoicing is working perfectly. And we were very deliberate about choosing Kenya for this because we're working very cohesively with our teams there to bring real life experiences to those who want to understand what this tax reform means for them, especially amid global trade developments. That's happening in November 17th to 20th. So guys, if you want to travel to Kenya, let's go. So thank you so much. It's been an absolute pleasure. I know we didn't address all your questions, but I think what we'll try and do is also look at those questions and maybe come up with an FAQ of sorts that can be shared afterwards. And in the Insight series that will come, I bet you that most of those will also be addressed there. So thank you once again, and do have an amazing rest of the day.